Hi, everybody. I'm Tara Lyons with Team Tara Lyons and Royal LePage, and I want to welcome you and introduce an awesome person who I just adore because he looks after my finances. Matthew, if you would like to introduce yourself and your company and all of that, we'll get started.
Thanks, Tara. Thank you. Thank you for the invite. My name is Matt Howell, and I'm a financial advisor at Park Place Financial here in Belleville. We have offices in Belleville, Kingston, and Peterborough.
We actually have some questions we're going to be asking Matt because everybody wants to know what the heck to do in this kind of a market right now. So this is really some great information for you to stick around for. How do you see the current economic trends in Belleville and the surrounding areas impacting personal finance and investment strategies?
Yeah, well, I think not only in Belleville, but provincially, nationally, and globally. We've been in a period of high inflation. It happened really, really fast, right? It hit us like a ton of bricks at the beginning of last year. Nobody saw the inflation coming. We couldn't correct ourselves fast enough. I think back to the beginning of last year, it's most evident when we go to the grocery store, right? A bag of baby carrots at the beginning of last year was $1, and now it's $3 for the same bag of baby carrots. Maybe it's getting better, but I'd like there to be something called realistic inflation. And realistic inflation would be the things that you and I go and purchase, because when you buy a bag of carrots for $1, now it's $3. That's a 200 to 300% increase in the price of what we're paying for the things that we buy, right? Now, of course, inflation is measured in more things than just what we get at the grocery store. And then there's the debt side of it, the interest that we pay. And I think high inflation is obviously bad for debt. And as a debt holder, right, I have a mortgage, and if you're looking to borrow, but we can partake in debt instruments in a small way just by going to your bank and buying a GIC right now. You can get a 1-year GIC for 5%. That's ridiculous. We haven't seen that in 15 years that I've been in the industry. I haven't seen a 1-year GIC at 5%. That's a debt instrument, right? We're actually lending money to the bank so they can use it for other purposes. So they'll turn around and lend that back out for a mortgage at 5.5%, but we get the 5% interest guarantee on that. And then through mutual funds and segregated funds and things like that, we have fixed income investments that where we're lending money to the government, and we're lending money to corporations through bonds. They give us a higher yield on our investment now on those lending instruments. So we don't have to have a lot of money to partake in that, but in the short term, anyway, over the next year and a half, pretty favorable market for being able to invest in fixed income investments and taking advantage of that high interest.
So there's some really great opportunity there for people that do have some extra cash and trying to figure out what to do with it. And those are a couple of opportunities for them.
Yeah, and you know what? Probably the best investment on a long-term scale is real estate. You can never fail with real estate. You can buy something, you can buy a piece of swampland right now somewhere, and 20, 25, 30 years from now, it's going to be valuable. Right? My grandfather, coming out of the Second World War, when he came home, they gave veterans a certain allotment of money so they could get resettled. And I think he had $10,000. And he invested that $10,000 and he bought a bunch of limestone waterfront that was useless for anybody except for farmers to draw their cattle across to get water. And then, 30, 40 years later, he was selling that at $50,000 a lot per 100 feet, right? Because it became a valuable waterfront. Problem with real estate is it's never liquid when we need it to be, right? Coming off a high. It's actually a good time to buy real estate, except it's not a good time to take on a mortgage, right? And as the interest rates start to drop, then your mortgage value goes up.
And I think that's key. So again, looking historically, we're in a better position today. Right?
Absolutely.
So with even though, everybody just got used to under 2%. And the fact that we're at 5.65, it's not a bad. It's not great because of what you're used to, but it's actually more realistic. So that leads into my next question, and that is, what advice do you have for first-time home buyers?
I think there's two pieces to that. One is there is a lot of vehicles out there, government incentives, government vehicles, government registered vehicles that we can use. I think the biggest piece of the puzzle for people that are looking to buy now is saving up for that down payment. Yeah. So there are some some government regulated vehicles that we can save in. The home buyers plan was introduced back in the 80s, actually. I think it was supposed to be a 1 year short-term solution that the government introduced to encourage people to invest in homes, to invest in real estate, and get the economy engine started again. So basically, with the home buyers plan, if you have an RRSP, you can borrow from your RRSP for the down payment of your first home, up to $35,000, and if you have a spouse, you can both access that. So up to $70,000 to help fund the down payment for a first home, towards a first home. So you have to pay back your RSP over the next 15 years,
yes,
so that you don't end up with a tax hit at the end.
Or you get the tax hit.
Right. Yeah. So you're kind of if you're not continuing to save for your retirement in spite of using the home buyer plan, you're putting yourself 15 years behind, right?
But you know what was great about it? What was great about it is it got us into the market. And fortunately for us, right, and most people in our area, we've been very fortunate, is it could get you to the next level. So it gets you into your first home. So then when you're ready to get into your next one, you're making that much more off the home, right? And so for us, if we'd have never used that to get in, it would have taken us a lot longer. So it worked for us.
And I have specifically used it as a strategy when I've had a young couple come and say, look, we just got married, we want to buy a house in 2 years. What's the fastest way to get there? Well, first you have to save, but if you save into the home buyers plan, into your RSP, and you generate large tax refunds, and then you reinvest your tax refund into that RSP, you're compounding your ability to save, and then you're going to access it for your. So, but now we have the first home savings account. So just introduced within the last year, the first home savings account kind of combines the best of an RSP and a tax-free savings account. So if you have RSPs already, then sure, that's a great place to access. But if you're starting to save for your first home or for the down payment for a first home, the first home savings account is a little more effective, because as you're putting money in there to save for your down payment for your first home, you're getting a tax refund, which you can equally reinvest back into that account and create more tax refund, right? Compound on it. But when you take out of it, if you take out to fund that down payment, you're actually not paying tax, right? The government's saying, well, the CRA saying, nope, that's okay. You've used it to help the economy and buy your first home, and we're not actually going to ding you on the tax on it. So if you're just starting to save now, then I would save in a first home savings account. But if you are if you have RSPs and you're looking for another way to fund that down payment, then maybe use the home buyers plan. Your first home probably isn't going to be your last home. Maybe it is. But
rarely.
Rarely. But if I were to go back in time and buy my first house again, I probably would buy a duplex, right?
We bought a triplex.
Exactly.
Yeah.
That was your first purchase?
Yeah.
Yeah.
So we lived in one unit. It was actually a fourplex, but the one unit hadn't been finished at all. And we rented out two, and we lived in one, and the other one we actually just used for storage.
But I mean, if I'm a first-time home buyer, that's definitely, the income.
What are some key strategies for retirement planning specific to residents in Belleville or Ontario?
I would say probably the most important thing in this day and age is to save. And I know that sounds so silly and so easy.
It's hard on a lot of families today.
It is, and I don't know that it's a generational thing. Access to credit in this day and age, or in the last 10, 15 years, has been just way too easy. So everybody has everything they want now. Now, necessities have changed from what we consider to be necessities from, the 80s when I grew up. We had hydro bill, you had phone bill, right? And if it was long distance, it better be after 7 o'clock at night. And possibly a heat bill. We always burned wood, but you really only had 3 bills in the household. Now we've got all those, plus internet, plus the television services that we pay for, plus the 9 different streaming services, plus every member of the family has their own cell phone. Everybody wants, because we live in this I can get it now,
Instant
generation.
gratification.
Yeah, I can feel good right now. We want the same thing from our investments and from
Yes.
planning. We want to put $50 away and get 22% interest because my sister's boyfriend's cousin's dog walker was in the dentist office and read a magazine that said we should invest in silver and we'll get a really good return. When in reality, the most important thing you can do from a planning standpoint is to save, because if you don't save, there's nothing to plan around, right?
Mm-hmm.
And a rate of return, getting 12% on $5,000 or getting 4 or 5% on $100,000 because you actually did some saving, right? The investor, the person in the planning process has to do their part. There's no miracles out here. There's no magic wands to wave to create money for people. You have to save. Yeah.
So for those that are just starting out with saving or who have a limited budget, what practical steps can they take to improve their financial health?
Well, I think there's two pieces of that. One is actually debt management, right? So investing in yourself, investing in your debt to a certain degree is probably the first place we should go, because right now debt interest is high and investment interest relatively low. So you really have to weigh out, okay, if I'm saving or if I'm paying down debt, where's the best place to put my dollars? So if you're paying more on your debt management, if the interest rate is more on your debt management than it is on your savings, then you should think about putting into your debt. And I always say with things, and I practice this myself, with things like car loans and mortgages, I never pay the minimum. Now that's easy to say, right? Oh, never pay the minimum, but you can do that out of the gate and you can do it in small bits and it makes a big difference at the end of the day. So with things like car loans, maybe your car loan is $542. Well, just tell them you want to pay $550. Most car loans have no penalty debt repayment, like per payment. So you're not going to notice that extra $8. So round it up to the nearest 5 or nearest 10 or nearest 50. You're not going to notice it so much on your end, but you're chipping away at the long-term aspect of that debt and the interest you're going to pay on it. And even with mortgages, I know that you can prepay a lot of mortgages. Some institutions have a once per year at a given time. I remember my first mortgage, I think, was with Scotiabank, and they actually had, I could make my prepayment with my mortgage payment. So at that time, interest was over 9%. And I can't remember what my mortgage payment was, but let's just say it was $222. But I paid $250. I said, well, just do $250. And then, that extra $8 over 25 years was eliminating a year and a half of debt retirement, right? And back then, and I don't know if you can still do this, I guess this is more of a conversation with a mortgage broker, but you used to be able to do something called a blend. So if you were in a 5-year fixed, and I remember that first, I think it was 9.25 was my first mortgage, and then all of a sudden rates went down to 7.5. And I did a blend, and it was like, okay, I don't get the 7.5, but I don't have to pay 9.25 anymore, and I'm locked in for a new 5 years at whatever 8.25. Yeah. So it was like in between, and then it seemed every year mortgage rates were dropping. Right, we're heading into the 2000s. Interest rates were dropping, and I just keep blending and keep blending and keep blending until ultimately I sold that house and bought into the next one. But interest rates have just kind of come up, so you don't want to blend, or you don't, if that's an option when things are going up. But when things are coming down again, and they might start to come down, well, maybe you locked in at 5.5% or whatever because of the timing and when you had to purchase. But talk to your mortgage broker, talk to your financial institution, and ask them, is blending still a practice? Can we do that? Can we take advantage of this new rate? Well, maybe you won't get 4.5, it goes down to 4.5, but maybe you'll get somewhere in between, right? And never make the minimum payment.
How important is insurance planning in overall financial health, and what type should residents of Belleville look at?
Well, I think that probably one of the most underrated, and everybody has car insurance, right? We all buy car insurance. You drive a car, you have car insurance. You probably have car insurance, Tara.
You have to.
You probably spend, I'm going to guess, somewhere between $150 to $200 per vehicle, maybe, for your car insurance, right? So what if I told you that I have a new auto insurance where I spend that same 150, $200 a month, but I get 2 oil changes every year, up to $100. I get my tires rotated and stored, up to $100. I get a new windshield every 5 years. If I have a crack or chip, it'll cover up to $500. Winterizing up to $250 a year. And if I hit a moose on Highway 60, of course, I get the work done. Or if I create a liability with my vehicle, it's covered just like any regular car insurance. Do you think that would be something that you'd be interested in?
Mm-hmm.
Yeah, we all would, because by the way, it doesn't exist.
No.
Maybe we should invent it, but that's literally private health insurance, right?
Mm-hmm.
So we do all these things to insure our vehicles and our homes and all our stuff, and we don't insure ourselves, right?
Mm-hmm.
Because the government doesn't tell us that we have to, right?
That's right.
Yeah, and it's probably the only insurance policy that anybody can buy where you actually get a return on investment, right? I have my individual health. Maybe you have a plan through work, but if you don't have a plan through work, you have an individual health. Well, okay, it costs me $200 a month, but let's see, I get my teeth cleaned twice a year, and there's extra coverage there if I get a filling. And you start doing the math, right? I can get $300 worth of massages. I got that prescription that costs me $100 a month that's covered. Do all the math and see what your net cost of pure insurance is. You're probably most individual health insurance, if you actually use it for your well-being, treating your body right, it probably doesn't cost you anything at all, because you can get a complete return on the investment. And of course, if you have an accident when you're traveling, you need an ambulance or semi-private hospital or a piece of medical equipment, like there's the what if factor, but it provides you a way to put money from your paycheck back in your pocket for the things we do, and then it gives you a little bit of protection for the what if, right?
Yeah.
Second to that, I think that we don't put enough value on the insurances that protect our most important investment. Now, if I ask most people, what's your most important investment? What do you think they're going to say?
My home.
Exactly. So I would challenge anybody that your most important investment is your ability to create an income to pay for that home. Right?
That would be me.
Right. So our ability to earn ensures that we can have all those things, right? So what happens if? And I talk to people a lot about disability income. I talk insurance. I talk to people a lot about critical illness insurance. The cancer rate and the incident rate for cancer in this country is near 50%. I think it's 49 point something percent, which means 1 in 2 people in Canada are going to have an incident of cancer in their lifetime. Mm-hmm. So we live through things now that used to be, if you had a heart attack in 1972, you had a single bypass, you're in the hospital for a month. Now you can have a triple bypass and be out of the hospital in 2 days, but you're probably about at least 6 weeks at home recovery, right? An incident of cancer, well, it could be easy. It could be like my dad, get a little piece taken off his skin every year, or it could take you out of the workplace for 6 months to 2 years, right? Mm-hmm. And how do you protect your income and make sure that you can still pay for the house if that happens, right? Mm-hmm. And I think the biggest myth out there is that the government will take care of us. The government will take care of me if I lose my job or if I get sick. The government will take care of me when I'm 65 and I need medications. Our healthcare system is getting smaller and smaller in budget and fatter in things that we need the budget for. And the only way that we can accommodate that is if we pay more taxes, and nobody wants to pay more taxes. Mm-hmm. But the fact of the matter is, it's not the responsibility of the government to take care of us. We live in a great country. People, we're
lucky.
We criticize our leaders and we criticize our governments, and we have the right to do that because we are Canadian. I still think we live in the greatest country in the world because we still can have access to healthcare, and we still can have access to long-term care. And we can have access to resources that in other countries they wish they had, or they have to pay for dearly. Yeah. But there is a limit, and the government isn't going to take care of every problem you ever have. It is our responsibility to make sure that, just like we have to have insurance in case something happens involving our vehicle, God forbid, that's what, the most important piece of it, of our car insurance, is the liability. What if we hurt somebody when we're in an accident, whether it be at fault or not? We want to make sure that other people are taken care of, and that's what we pay for the insurance for. And then with regards to our health and our income, well, why do I buy disability income, or why do I have long-term disability coverage through work, and why do I have to pay the $25, twice a month on my paycheck for it, or why do I need critical illness insurance? Because you are the most important investment you own. Like, your ability to create an income. Most of us live with our nose right at the waterline, and I would say most of us live probably at 100%, 110% of what we earn. So if you're on a long-term disability and all you have is the government benefits, you might get $2,000 a month taxable. If it's a short-term disability, you might get 55% taxable. How long could any of us survive on 55% of our income? Not very long.
So it really is a key piece that a lot of people forget about, or honestly, some just don't even know about, right? Yep. And as we mentioned earlier, the change in the jobs that we have, where you're not getting the benefits through your employer anymore, it's even more important for you to have your own.
Absolutely.
So talking to somebody like Matt, who is very familiar with all the different ones, and being able to look at it and go, okay, how does this suit you? Because, okay, your partner gets this, you don't have it. Do you qualify for anything under theirs? Like, there's so many elements in it that you need to take a look at. You need the expert to be able to walk you through it, right? So you're also not overpaying and over-insuring at the same time. So
yeah, and I think at minimum, like with regard, like creditor protection insurances are usually cheap, and there's a reason for that. But just with your mortgage, you make sure that you insure it. Make sure that at minimum, if you don't talk to somebody like myself and buy individual insurance to protect that debt, that you're at least opting in on the creditor protection insurance that's available to you through the financial institution in most cases.
I think that's a key piece too, because a lot of people just automatically go with the insurance that's provided by whoever's giving them their mortgage. And there's all kinds of other options for you. So again, it's talking with Matt and saying, do I take that insurance? Do I need to pay for that insurance when I take that mortgage? Or because I have this that I'm paying over here, I don't need that. And I'm not saying don't go out and get mortgage insurance. I'm saying you need to talk to somebody and say, what's the best thing for you to do?
Yeah, right? Just know that there's more options than what's being laid in front of you by your lender.
What are your predictions for the financial planning industry and client needs over the next 5 to 10 years?
Well, contrary to popular belief, I'm not Kreskin. We can't predict the future. If any of us could, nobody would have lost money last year. We markets are cyclical. This is what I know. And history is our best teacher. And every time we have a sharp downturn, and I guess we could argue a little bit about what part of the cycle we're in now. Have we had a downturn? Or have we hit the bottom of the trough? Are we in a period of recovery? The last big downturn and correction that we had was back in 2008. And if you lived through that, then you know where I'm coming from, that, you never know how low it's going to go. What I do know is that from my observation, looking back in history, the markets are cyclical. So in every 10 years, you're probably going to have 7 good years where you're earning interest. You're making a living, you're saving, you're getting your statement at the end of the year, and you're happy. And you don't call us because you're happy. There's probably going to be 2 years, and we could argue that this is one of them, and possibly last year, where in that 10-year cycle where you're getting your statement at the end of the year and you're going, oh, I wonder if Matt knows what he's doing. And there's going to be 1 year I call the shotgun year, where you get your statement and you're looking for us with a shotgun. And that's because and it's a cycle of the market. And 5 to 10 years from now, we could have a different government. And we all want change, but I would warn that, be careful what you wish for, because when we get change, we're holding a lot of debt in this country right now. So a new government will probably put measures in place to try to control and reduce that debt. And we're probably going to not like them for doing that either. So we're we're never really happy. But from a planning standpoint and a saving standpoint, I think that a change in government might give us a boost from an investment standpoint. I know that there's signs in the current marketplace that maybe we're not happy with our leadership. Mm-hmm. I'm not going to say that I lean one way or the other, but I will say
we don't get political.
No, we don't get political. No. But I will say that things are cyclical. So, every 10 years, there's going to be an up year. There's going to be a few up years. There's going to be a couple down years. And there's going to be one rotten year. But over the long term, working with a planner, working with somebody like myself or one of my colleagues, or talking to the person at your financial institution, get them to pull out an index chart and show you, history, what it looks like when we have these little corrections and what things look like over the long term. The worst thing anybody can do is panic and move away from the marketplace in a time where they suffered a loss, right? Mm-hmm. And
it's only a loss when you pull it out.
It's only a loss when you pull it out. And it's like the same thing. I got to sell my house. Interest rates are going down or interest rates are going up and the value's going down. I got to sell my house. I got to sell my house. I got to sell my house when it wasn't really part of your plan, but you want to take advantage of the market for real estate right now. Mm-hmm. Well, if it's not part of your plan, don't worry about it. When did you want to really sell your house? Well, we planned on being here for 10 years. Well, then let's look at selling your house in 10 years. In the meantime, the real estate marketplace in general is kind of cyclical too, right? When I talk about these 10-year cycles, beginning of the 1980s, beginning of the 1990s. I can't really, I guess, a little bit later, right? And then, of course, what we're experiencing right now, we're seeing these cycles. There's peaks and valleys, and we're going to see that in the financial world as well. Unless you are retiring in the next 3 years, in which case you probably should have had some adjustments into your plan in the last 3 years. Don't panic. When you get your statement this year or last year, they're difficult conversations to have with your advisor. But if you're having a conversation with your advisor, it means that you're working with the right person. When they're going through tough life experiences, when somebody's sick or when they lose someone close, right? That's when we're there.
It's true. And I mean, this is, you mentioned earlier about how quickly our market changed, and it did here as well, right? It changed so quickly here that things just started declining very fast over a period of weeks. And we have clients that are living through that, and it's affecting their bottom line. And that's in real estate, that's in the financial industry, that's in all aspects, because that's where we are right now. And so it's again talking with us to help you navigate through that and figure out what the best course of action is for you. So I think on that's a wrap.
Cool.
And I want to thank you very much, Matt, for joining us here. Really appreciate it. Loved your insights on so many different aspects of what's happening. And I know that people are really going to appreciate that. We're going to put in the remarks there as well, your contact information. So if anybody would like to sit down and chat with Matt and of course myself, please comment here and we can get in touch.
Awesome. Well, thanks for having me. It's been a pleasure. Sweet Tara.